In just a few hours, Donald Trump managed to squeeze gold prices down nearly 10% and silver by over 25%. But how did this happen? Let's unravel the story. Recently, we saw gold and silver hit all-time highs, driven by investors seeking alternative stores of value amid a dollar losing credibility. Yet, when prices soar this high, the risk of a sharp pullback grows. That pullback came suddenly last Friday, triggering one of the sharpest crashes in 4 decades. Gold plunged over 10% intraday, and silver crashed more than 30% at one point before closing down 26%. What caused this historic plunge? Partly, it was the unwinding of heavily leveraged positions. When asset prices fall, margin calls force leveraged investors to sell collateral, accelerating price drops. But beyond margin calls, a rare market event called a gamma squeeze played a key role. Here's how it works. Dealers who sell call options giving buyers the right to purchase silver at fixed prices hedge their bets by buying silver futures. When silver's price rises, these hedges grow, pushing prices even higher. But when silver falls below certain strike prices near option expirations, dealers unload futures contracts, intensifying the price drop. This vicious cycle fueled Friday's collapse in both silver and gold. Still, margin calls and gamma squeezes explain the crash's momentum, not the initial trigger. That trigger? Trump's announcement of Kevin Warsh as the next Federal Reserve Chair, succeeding Jerome Powell. Markets interpreted Warsh's appointment as a signal of tighter monetary policy, reducing the likelihood of easy credit and federal borrowing that had been fueling inflation and dollar depreciation. In other words, Warsh's name suggested a shift away from the reckless fiscal and monetary expansion that has eroded trust in the dollar's value. If this holds true, it's a positive signal. Restoring fiscal responsibility could strengthen the dollar and reduce the appeal of precious metals as safe havens. But here's where it gets tricky. If Warsh fails to deliver on these expectations, or if Trump's administration reverses course, gold and silver prices could rebound strongly. This episode highlights the delicate dance between market expectations, government policy, and real economic incentives. When states overreach with debt and monetary easing, markets respond rapidly, sometimes violently, to recalibrate. Ultimately, this crash is more than a price movement. It's a reflection of competing visions for America's economic future, between fiscal discipline and the old habits of excessive intervention that threaten long-term prosperity. What comes next will reveal if markets are right to bet on restraint or if history's lessons go unheeded once again.